Most traders think candlesticks are about patterns, engulfing, pin bars, dojis. But what if I told you there is one rule that flips how you see the market? And it changed everything for me. After this rule, boom, cleaner entries, tighter stops, real confidence. Hi there, I'm Kojak's Pro, a trader with over 3.5 years of experience. Trading can look daunting for a lot of beginners, but with practice and experience and exposure to the right knowledge, you can beat this game, you can beat the market and become profitable and get to live the life you've dreamed of. It's important as a trader to learn the right things that will add value to your strategy and give your trades a highly probabilistic chance of hitting take profits. And in this video, I'm going to be sharing how I look at candlesticks and the trade things or criteria I wait for before actually making any trade entry based off candlestick pattern. If you're new to this channel, subscribe because you don't want to miss insights like this that will help you in your overall development as a trader. So without wasting so much time, let's get into the video. Traders focus too much on individual candles rather than the context they appear in. It's more like they look at candles in an isolated manner without merging them with insights from the market. Candles are like words, but without sentences, they tend to be misinterpreted. This leads to overtrading and false entries. I used to enter every bullish engulfing candle I saw when I started out earlier on in my trading, and I paid the price. The one rule that I use, which could be your takeaway from this video, is that candlesticks only make sense in context. And I'm going to break it down into 3 layers of context. 1. Trend context. Is price trending or consolidating? A bullish candle in a downtrend isn't bullish, it's often a trap. 2. Location context. Is the candle at a key level, maybe a support level or a resistance level or a Fibonacci area? Candles that are at a swing high or swing low are more reliable. 3. Volume or session context. Did it happen during major session overlap or team volume? Candle strength without volume is most often times a fake out. When I began filtering candlesticks through these layers, my win rate jumped. I stopped trading noise and started trading real signals. Now let's look at a live chart breakdown on this. This is Euro USD, and I'm just going to be showing this on the 4 hours on Euro USD. This is price. Price made a swing movement to the upside, like so, like you can see here, and then came back to retest this area. Now let's understand what's actually happening here. For illustrative purposes, this area, this entire area you can see here, this entire area you can see here is a support level, and I'm just going to mark it as orange. Now when price moved here, price made a swing high, and then price now returned to make a higher low, because this low is higher than this low, which was the previous low it came from. So this is a higher low, and it's also stopped at the previous support level. Now when that happened as well, what can you see that is happening on this chart? One more thing you should also look at now is that if I'm to take my Fibonacci from swing low to swing high, you can see very well clearly that this market stopped at a major Fibonacci area, which is the 50%. You can see this area is the 50% Fibonacci area, and that can be illustrated here. So this is the 0.5 Fibonacci area, and that's where price stopped. Now, how many of these criteria have been respected? We've respected support, we have respected Fibonacci. Now let's look at our candlestick pattern in this case. Watch what happened right at the base of the support area. Now if you can see here, this looks pretty much like a morning star pattern. So if you see this, you can see that this is a reversal candlestick pattern, and it has formed at a major or a key level, and it also respected Fibonacci, the 50% Fibonacci, and as well has created a reversal candlestick pattern around that same area. So what makes this trade not to be a winner? So if you were able to put these 3 criteria together and take a trade just based off this, you can see that you will have made a very good decent profit. So if I were to put my buy signal from here just after a break above the, so let's say I put my signal here just after a break above the support level, and then my stop loss just below the candlestick, and I aim for the most recent high or the next support level, as the case may be. So this gives me a risk reward of 1:4. And you can see very well clearly that we got our take profit right here. So that just shows that once you respect candlestick patterns that are formed in context to market structure, in confluence with the different tools or strategies you put in place or criteria put in place to take trade entries, not just isolatedly on its own, you stand a better chance of making your trades profitable. Let's take another example, still on Euro USD. In this case now, this is the 4-hour chart. Euro USD is still in an uptrend. You can see that we are making higher highs. You can see this is this is higher high, higher low. Then we have potentially made a higher high because it's higher than this one. So we have potentially made a higher high right about here. So we are bullish on Euro USD. So this is the temporary high that has been created for Euro USD. So I'm just going to mark it out with a line. Now the reason I'm marking out the line is so that this can serve us. So this is the last high. If price breaks above it, it now changes from being a resistance to a support, because price will have to come and retest it for me to be looking for trade opportunities. And that's how I love to trade. I love a retest of every level before I take my trades. I don't usually take on a break. I usually take on a retest most of my trade entries. So that's just it. So now price has hit and made that high. All I need is for price to break above it and retest it for me to bring in these three factors I talked about: confluence, let there be a trend for that, let there be a support or resistance level, which is a key level for that, and let it also respect Fibonacci area as well. At the same time, let it give us a reversal candlestick pattern or a normal candlestick pattern. Then I'll jump into the trade. And this was a trade I took in last year, actually September last year. So let's see what happened here. So you can see here that price has broken above that level like we talked about. So price broke above this level. So price broke above this level right here, and it's already trying to retest it. So I'm just standing patient on my hands and waiting for this retest to actually happen. Now I'll only be interested in trading opportunities when price comes back to hit this zone, which is our level. That's the only way I'm interested to take a trade from. Now let's see whether price did that. So you can see that price has touched it. What I'm waiting for is a reversal candlestick from here. So price has hit the zone very well. So the first one has been respected. We are in an uptrend. Price has come back to test that zone, and I'm waiting for a reversal candlestick. So as we see here, we don't see a reversal candlestick here, but if we just go over to the daily time frame, you will see something remarkable. What you can see on the daily time frame was crazy. A huge bullish engulfing candle off that support area. A huge bullish engulfing candle off that support area. So by the time I saw this, I was quick to take my buy trades. I took my buy trades. My stop loss came just below this one and take profit at the most recent high that was created, which is the 100% retracement. So this was how I got into this trade. So this was how I got into this trade. I just put my buy entries just at the close of the daily. My stop loss came just below the recent one, and then my take profit was here. So this is how I got into this trade, and from there you can see that we have massively hit our take profit area before the market spun around. That's just exactly how to go about using candlestick patterns, and you use it only in confluence with market direction, support existing key levels, and also a Fibonacci area. Because if you look at here closely, there was a Fibonacci area here which we didn't talk about. So the Fib area here was, let's go to the 4. So given that this was the most recent swing high, our Fib starts from swing low to swing high, and you can see very well that we are at the 50 Fib. Easy, straightforward. I love explaining things like this so that it can be very, very visible, and you can understand how price actually works once you combine elementary and nice tools to your advantage as a trader. The trades I showed you are the kind of setups I wait for. I don't just wait for candlesticks to fly up a level. I am always combining candlesticks with context. I love candlesticks to tell me a story before I take my trade entries. Here are the mistakes traders make without this rule. 1. They take impulsive entries off surface level patterns. 2. They misread reversals as continuations or vice versa. 3. They get choppy results with no data-driven edge. If this rule helped you see candles differently, drop a fire emoji in the comments. If you love this video and you want to learn how to plot your support and resistance levels better, watch this video right here.